Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Enbridge's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Enbridge owns, transports, and stores crude oil, natural gas, and renewable energy. To put it simply, it makes money by storing and moving energy through its pipelines to various customers in the US and Canada. It transports 20% of the natural gas consumed in the US, supplying natural gas to 170 million people. They transport 30% of the crude oil produced in North America to 25 refiners across the US Midwest, the US Gulf Coast, and Eastern Canada. It also has ownership interest in 48 renewable energy facilities. The company plans to produce net zero greenhouse gas emissions by 2050. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1949. The ticker trades on the TSX, New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a large cap company, 116 billion market cap. They're trading at $57 a share, and they have 2 billion shares outstanding. We're looking at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 3.2 billion to 4.2 billion. Then in 2021 it dropped to 1.2 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that peaks in 2021 at 6.3 billion. Revenue is a sales for the company, and that was low in 2020 due to low oil prices, but it came up a lot in 2021. It's 47 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in 2019 at 15.7 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And that's pretty strong at 7.8 billion. It was highest in 2019 at 8.7 billion. They do have a lot of debt, so they spent 2.7 billion of interest on their debt, which is a little lower than 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. The gain on the sale of one of their divisions is an example of something in this category. And that's why their net income was so high in 2021, was this large gain of 2.6 billion. I would just focus on operating income when I look at the income statement, not necessarily net income. This is the company's income statement from their annual report. They break down their revenue into three categories: commodity sales, which is their biggest at 27 billion, gas distribution sales at 4 billion, and transportation and other services 16 billion. They don't really make any money on commodity sales. It cost them 27 billion, and they sold it for pretty much the same amount. Their margins on gas distribution are a lot better. The revenue was 4 billion, the expenses were 2 billion. But they are a midstream company, and a midstream company stores and transports oil and energy. So that's where they make their most margin, the most money. Even though it was 16 billion, that's where most of their profit is. Their revenue grew a lot from 2020. It's down a little from 2019, 47 billion in 2021. Even though they're a Canadian company, they generate more revenue every year in US than Canada. Which makes sense. The population of Canada is only 40 million. The US is 340 million. And we share a border, so it's probably easier to transport to US than most parts of Canada. They spent 6.7 billion in operating and administrative fees. This includes payroll for support functions and about 4 billion of depreciation and amortization. Their operating income is a little lower in 2021 than 2020, but their revenue is much higher, so their margins are terrible in 2021. They generated 1.7 billion of income from equity investments. A company uses equity method accounting when they own between 20% and 50% of another company. So Enbridge reports that company's income as a gain or loss on their income statement. And they passed through a large asset impairment in 2020 of $2.4 billion. This is when you decrease the value of an asset on your balance sheet and pass through a loss onto your income statement. That's why their net income was lower in 2020 compared to 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Their operating cash flow is fairly similar year to year. It's between $9 and $10.5 billion. They spent a ton in CapEx in 2021. That's why their free cash flow is so low. They're investing in a lot of projects, and this should lead to greater free cash flow in the future. Operating cash flow minus CapEx gives you your free cash flow. And they do pay a nice dividend with their free cash flow. They also buy back stock each year, a few $100 million a year, although in 2020 they didn't buy back any. And to fund all this CapEx spending, they did take on a lot of debt. They added over $11 billion in 2021, paid down $2.3 billion. They also added debt in 2020 and 2019. They paid down about $3 billion of debt in 2018. This is their operating cash flow section from the statement of cash flows. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. So you can see how volatile their net income is. It's kind of all over the place, but their cash flow looks smooth because generally cash eliminates all the accounting noise. They reported a net profit of $6.3 billion. We add back $3.9 billion of depreciation and amortization. We minus out that gain from the equity investments. That's a non-cash item. But they did receive $1.6 billion of dividends from their investments. That is a cash item. Even though they reported an accounting profit of $6.3 billion, they actually brought in over $9 billion of cash flow. In 2020, they reported an accounting profit of $3.4 billion and brought in nearly $10 billion of cash flow. The big difference was that asset impairment of $2.4 billion. I like to track a company's revenue, that's the blue line, and their operating cash flow, that's the orange line. And both look really good. These are their numbers since 2015. And their revenue does move with the price of oil. So if oil is really high, their revenue should be higher than when oil is low. But they are a midstream company. If they were an upstream company, their revenue would be highly correlated to the price of oil. Midstream companies are less reliant on the price of oil than upstream or downstream. The forecast is for their revenue to go up a little bit, then down, then up in 2024. While their operating cash flow is up a little bit in 2022, then pretty flat after that. This is their investing and financing sections from their statement of cash flows. And they spent a lot on CapEx, nearly $8 billion in 2021, $5.5 billion in 2020 and 2019. They also did some acquisitions in 2021, nearly $4 billion. A few months ago in October, they acquired Midstream. And they paid 3.7 billion Canadian dollars or $3 billion US dollars. They received 1.3 billion from the disposition of an asset. So in their investing section, they had a cash outflow of 11 billion. In their financing section, they added 3 billion on a credit facility. They sold 8 billion of debentures. They bought back 3 billion of debentures, and they paid out 6.8 billion of dividends. So they had a cash inflow of 1.2 billion. This is the equity section on their 12/31 balance sheet. They have 61 billion of equity. They raised 8 billion from selling preferred stock. They raised 65 billion from selling common stock, and they lost 11 billion from running their business. Deficit is the sum of all their prior net incomes minus the sum of all the dividends they paid out. But they are cash flow positive because the income statement brings down your numbers a lot due to all those non-cash items like depreciation, amortization. Let's look at the capital structure. 61 billion of equity, 76 billion of debt. They're 45% equity, 55% debt. This red line is their debt balance since 2015. The blue line is their equity balance. So the debt was a good amount higher in 2015 and 2016. Then starting in 2017, their equity was higher. Now their debt is a little higher. Ideally, you'd want your debt to be lower than your equity. But as long as the company can pay its bills and pay out a dividend, then I guess everything's fine. I gave them the lowest whack on Finbox, which is also the whack on Simply Wall Street, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 114 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $101 billion. We divide that by 2 billion shares. And we get a calculated stock price of $50. They're trading at $57, so they're trading at a 15% premium. It's a sell according to the model. I forecasted their revenue to grow 12% for the next 4 years. Because they're investing so much in CapEx, I think they're going to have pretty strong revenue growth going forward. And I think their free cash flow will be higher than the past, because the reason it was so low in 2021 is because they invested so much in CapEx. I think all those investments will start to pay off. The website Simply Wall Street values the company at $71. They're saying it's 20% undervalued. 10 analysts priced this stock and the average price target is 46, the low is 42, the high is 48. This is where the stock has been trading the last 5 years. So you can see it was all over the place. 5 years ago, it was about $55. Then it came down, and then it came right back up to that point. Then COVID hit, and the stock took a major decline. But it's come up a ton since then, and it's trading pretty close to its all-time high. In the past 5 years, this stock is only up 3%, while the S&P is up 90%. But you also get a nice dividend with this stock, so if you compound the dividend, it would be a little higher, but not nearly as close as the S&P 500. The company raises their dividend each year. They're up to 86 cents a share. That's over 6% dividend yield. That's why a lot of people love this stock for the dividend. It is 600% of their free cash flow, but that's only because they invested so much in CapEx. You need to look at this percentage over a long period of time, like 5 or 6 years. Maybe in 1 year or possibly 2 years, it's going to look like this. But over a long time frame, it can't be over 100%. Since 2008, they've been growing their dividend at a 13% CAGR. 66 per share in 2008, up to 344 expected this year. They've raised their dividend 27 consecutive years. They also have a share buyback program in place. That's how you reward investors. Give a dividend or buy back stock. Their dividend was about 2.5% from 2011 to 2015. It broke through 8% when the stock price crashed during COVID. But the yield has come down since the stock price has come up. And now it's around 6%. And the forecast is for the company to continue growing their dividend yield slightly over the next few years. They've done 3 2-for-1 stock splits in 99, 2005, and 2011. Their beta is pretty close to 1, so the stock moves with the market. It's gone up 24% in the past 52 weeks, while the S&P is up 13%. The 52-week low is 45, the high is 58. The stock is on an uptrend, trading above its 50-day and 200-day moving average. This is a really popular stock. Over 10 million shares are traded each day. Pretty much all the shares outstanding are on float. 52% are held by institutions, and about 4% of the shares are shorted. Their employee count peaked in the beginning of 2020 at 13,000. Then they laid off some people due to COVID. They're currently at 11,000 employees. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $18,000 today. That's an 83% return. In the past 12 months, there's been 2 insider buys, 1 sell. The sell was for a lot more shares than the buys. Half the shares are held by the general public and half by institutions. Only a small percentage by individual insiders. Their biggest shareholder is BMO, Bank of Montreal, 3.8%. Then RBC, Royal Bank of Canada, 3.4%. Then Vanguard, 3.3%. Then 2 other divisions of RBC own 2.5% and 2%. Let's look at their financial ratios. They have a pretty good PE at 18, that's stock price over earnings per share. A good price to sales of 2.5, that's stock price over sales per share. And a good price to book of 1.9, that's stock price over book value per share. Let's look at their non-current assets. $100 billion of PP&E, $13 billion of investments in other companies, $8.6 billion of deferred assets, $4 billion of intangibles, $33 billion of goodwill. Goodwill is the premium you pay when you acquire another company, and $500 million of deferred income taxes. This will help decrease their taxes in the future. Let's look at their non-current liabilities, $68 billion of debt and $12 billion of deferred income taxes. This will increase their taxes in the future. Their return on invested capital is only 5%. They can cover the interest payments with their operating income 3 times. They have a good ROE of 10%. A company can inflate its ROE by taking on a lot of debt. They can only cover half their current liabilities with their current assets. Their quick ratio is even worse at 0.4. Let's look at their current assets. They don't keep much cash on their balance sheet, only $300 million. $6.9 billion of accounts receivables. This is how much money is owed to them. And $1.7 billion of inventory. Let's look at their current liabilities. $1.5 billion of debt. $10 billion of accounts payable. This is how much money they owe others. And another $6.2 billion of debt. They generated $1.2 billion of free cash flow in 2021. They have negative $9 billion of working capital, and they pay out $7 billion of dividend payments. So it looks like they're going to be short $15 billion. Their free cash flow should be a lot higher in 2022 than 2021, but it's still pretty likely they're going to need to add a lot of debt to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 58 companies in the same industry as Enbridge. Enbridge is the largest midstream company by far. I converted all these market caps to Canadian dollars, so they're equal. This industry tends to pay a really high dividend. They're a little higher than average. Their price to book, price to earnings, and price to sales are a lot better than average, but their price to free cash flow is a lot worse than average. That's mainly because they invested so much in CapEx in 2021. Their revenue isn't growing much the past 3 years, and their ROA, net income over assets, is exactly average. Same thing with the ROE, it's average. To summarize, I have them trading at a 15% premium, and I think this is a pretty safe stock to hold. I know a lot of Canadian people like this stock because it's a Canadian company and it pays a really nice dividend. For a long-term hold, I think it's fine. In the short term, it could be a little volatile, especially if oil prices go down. But a lot of people think they're going to continue rising. If that happens, so should the stock price. I rank their free cash flow as 5 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.